Good afternoon, ladies and gentlemen. Welcome to our latest market briefing. Always a joy to see everybody here. Today is entitled Growing Your Own Insurer. It's one of those nuances that the PRA have never managed to quite understand. My dear colleagues here from Price Bailey are going to tell you all about how this works. We have Paul and we have Solly. They'll introduce themselves and tell you their background. I'm not going to do CVs. I don't do that. With that, I will hand over to... I'm not sure who's talking first.
Me.
Well, there you are. I'm going to hand over to Solly, let him present, and I'm going to come sit down in the audience and listen to this fine presentation. Good luck, gentlemen.
Thank you. Thank you, David. I believe these things traditionally start with a bit of an introduction as to who these people standing up in front of you are. We did prepare some wonderful words which tell you all sorts of good things about Paul and myself. I'll start with Paul. Paul's partner at Price Bailey Wealth Solutions and the head of Fiduciary, which is the part of the company that is talking to you today. Paul's got over 20 years' experience advising on the formation and running of offshore structures, family office establishment, non-traditional trust and company structures, works with large organisations in the field of trust, company administration, fund management, unit-linked insurance and insurance management. Apparently, Paul provides solutions that make everyone feel like they've got their way without compromising the integrity of the outcome, and believes that getting to know the people behind the structure ensures a long-lasting relationship as it builds trust and confidence.
You can tell our marketing team had a hand in writing that.
This is, of course, all true because Paul is my boss. I've got 21 years of insurance experience. I moved into aviation and marine insurance broking in 1996 after a career as a power station engineer. Moved into captive insurance management with Marsh in 2000. I've worked for Heath Lambert and Aon before joining Price Bailey to launch the insurance management division. I've worked with companies of all sizes, from SMEs in the construction sector up to large FTSE 100 PLCs in retail and all sorts of industries. I've got an engineering background, so a good eye for detail. I kind of just enjoy what I do. Introductions out the way. Today we're going to introduce you to the concept of managed insurers. This is where you own an insurer, but we do all the day-to-day operational work, leaving you to carry on running your business. Now, in a reversal of the way Paul and I normally do things, Paul is going to deliver most of the technical content in his largely non-technical way, and I'll explain, probably quite technically, how that content translates to building long-term relationships with your capacity providers and how it translates into the ability for you to generate additional profits. By the end of this presentation, these are the learning objectives, so for your CPD points, for those who have only turned up for the CPD, you'll be able to list the types of offshore corporate structures used to retain insurance risk. You'll be able to outline the relevant transition process between these structures as needs and requirements change. You'll be able to understand how you can use these structures and processes to share insurance risk and underwriting profit with your capacity providers. And we'll also touch briefly on the process of onshoring. We are Guernsey based, but it's possible to bring your insurer onto the UK and have a fully fledged UK licensed insurer at the end of this process. Right, quick explanation of what Paul and I do. Rather than employing staff directly, most licensed insurers in Guernsey outsource their operating functions to a licensed insurance manager. In fact, Guernsey has more licensed insurers, 835 at the end of last year, than there are staff working in the insurance industry in Guernsey. Overall responsibility for the activities of the insurer rests with the board of directors, but the day-to-day administration is carried out by the staff of the insurance manager as if they were working directly for the insurer. Price Bailey, that's us, is a licensed insurance manager. I'm now going to hand you over to Paul, who's going to take you through the next steps and some of the technical content.
Thank you, Solly. And just in case you are worried, I don't do technical. That is Solly's job, and he will dazzle you later on. On Guernsey, as with many offshore jurisdictions, there are really two types of companies. The first one is cellular, and the second one is non-cellular. Everybody will be familiar with a non-cellular company. It's the same as you've got in the UK. It's a limited liability company or limited by guarantee. You have shareholders and you have no segregated portfolios underneath. However, Guernsey in 1996 developed the concept of cellular companies. And this is where insurance becomes far more interesting in the offshore marketplace. A cellular company allows for one legal entity to be put in place and licensed by our regulator, and then cells to be formed around the outside that are licensed in their own right but rely on the core for the main regulatory oversight. And those cells can then act independently and write business. It is completely segregated and isolated from every other cell. To put this into a housing context, I don't know why we're using housing. Please ask Sully later because he designed the slides. The core is your foundations. That's where you get your stability from. That's where you get your board of directors from. That's where you get your base from. The insurance manager, which owns the core shares, then builds the infrastructure up and around and builds the apartment, so to speak, within the apartment building. And then yourselves that would like insurance companies come and rent an apartment building from the insurance manager. The apartment building is completely isolated and separate from everything else and segregated in that sense. What activities are conducted within the cells are down to each individual cell owner, which will be yourselves. How you do business is, whilst the insurance manager will look out for what you're doing and make sure it's legal, the cell business is down to you to determine. The insurance manager provides the oversight and the governance and the board of directors. As cell owners, you have no rights to actually step in and appoint board of directors. That's your major downside to a protected cell company. You have to rely on us as insurance managers for the governance. Cell assets are ring-fenced, as I've mentioned already. Moving on to non-cellular companies, Solly akin this to the 3-4-bedroomed detached property with a nice acre of garden. So you would have your own board of directors, you would find and source your own non-executive director to provide the governance oversight, and you'll notice the lovely double doors there. That's to allow you to open them up and flood all of your new business into it. As a standalone company, you'll be subject to your own regulation. So if you go standalone rather than cellular, it's at this point that you'll discover all of the regulatory oversight that Guernsey or other jurisdictions for that matter will bring to bear. Be that business risk assessments, the corporate governance code, the compliance manuals, the anti-money laundering, all of that type of thing that we would have taken care of for you at the cellular level will now be your responsibility. The whole purpose of an independent non-cellular company is to allow you to be more agile, more independent, so you can have your own directors. You can set your own agenda. You're not answerable to us as insurance managers as much as you would be with the cellular company. The next part of the presentation is what happens as you grow. Most owner-managed insurance companies start out as cellular. That's the cheapest, most cost-effective way of doing it because we take care of all the regulatory side. However, if you start out and you grow to a size where you think you want to become independent, you can simply spin out the cell and take it out of our cell company and create a standalone independent company. The nice thing with this piece of legislation on Guernsey is that when you take your cell out of the cellular company and create the standalone, all of your history, all of your background comes with you. And it's treated as if the non-cellular company was there from day one. So all of your trading history stands from day one. And that will then help you to later on decide what you want to do with the business and where you want to go. Once you've turned into a non-cellular company and you're standalone, I'm sure your minds will go to places that mine would as well of how can I monetize what I've got there and can I sell it to any of my colleagues? And the simple answer is you can then turn your standalone vehicle into a cellular structure. That cellular structure you can then rent out cells to your friends. So you're basically copying what we did originally as an insurance manager. So you can have your own protected cell company. And then you'll make your money from the transactions that your colleagues, your friends put through their cells. There is a link there to the legislation, which I believe slides will be given out if people would like them. I'm not going to go through it in too much detail. The question then comes, what happens once you've grown your own cell, or grown your cell, turned it into a non-cellular company, and you've actually got too big for the offshore jurisdictions? So people are sat there thinking to themselves, it'll be nice to have an EU insurer at this point. How can I go from being Guernsey-based to being an EU and have passporting rights through EU? I know that's a challenging question over the next 2 years with the UK, but I think EU is still quite important for the insurance market. The nice thing with Guernsey and most EU countries is that you can actually pick up a company from one jurisdiction and re-domicile it into another jurisdiction. UK is an anomaly. UK currently doesn't have re-domiciliation rules within its legislation. They are looking at it. We believe they'll come in 2020, 2021, so it's not going to be any time soon. By picking up your Guernsey entity and dropping it into another EU domicile, you will then have full passporting rights into the rest of Europe. There are catches to all of this. I haven't mentioned a lot of them, but one of the catches to re-domiciling is the fact that you will need to be Solvency II compliant when you re-domicile. However, the previous 5-10 years would have allowed you to build up your capital base in Guernsey to get it to a sufficient level to then actually enter the EU market. And that's the whole point of the transition across. If anybody can actually tell me what that map is below the UK, bear in mind there is a line, then I might buy them a drink later because it took me a while to work it out. Well, that's one correct answer. I was sat there on my phone going, I can't understand what that is at the bottom. And then I realised there was a line across that my phone had taken out because it could have been Jersey and Guernsey. Once you've re-domiciled to Malta, as the example is up here, that will give you EU access. But then you can also look to create branches and other structures in the UK through the passporting rights into the UK. Solly will touch a bit more on that later on, I believe. No, he won't. He might do if you ask him the question. That sums up how you can move your entity from one jurisdiction to another and how you can grow from a cellular entity into a full-blown insurer. The key points from me are that you need to consider your cost base when you start. Starting as a cell can save you in fees and general costs between 20 and 30,000 a year. And then once you're ready, you can move into your own standalone company and put your own board of directors on and other matters. And then once you're ultimately ready, re-domicile to Malta. The whole process from start to finish is quite easy for an insurance manager to deal with. From your side, I can see lots of blank faces, lots of people thinking, how can we actually achieve this? And that's where our services come in. We've done a number of these where we've taken them from a cell stage into a non-cellular and then into the EU via the UK marketplace. The key things to remember are you need to understand your risks, how much you want to retain within the cell structure, how much control you would like as well. Because you can't appoint directors to that board, you're going to have to rely on professionals like ourselves saying, we have a fit-for-purpose board. Come and meet our non-executive director. Come and meet our executive directors. Come and have a look at our policies and procedures. Another point to mention, which isn't covered in Solly's but is very important, it got brought up when we were outside. Whilst we are insurance managers and we provide the staffing infrastructure to it, it is possible for you to actually have your own office in Guernsey and still be a managed insurance entity. That can be achieved a number of ways. The first way is employing staff direct, but relying on us as a managed service provider to oversee all your regulatory and governance needs. The second way is to say we've got our own office in Guernsey, but we're going to second all of the staff from the insurance manager. And the final way is that you actually just have a brass plate, which is how most insurers start out. And it is a brass plate with a registered office, and you are on the regulatory website. I think that sums up everything that I was meant to talk about in a very rushed start. I am right, yes. So back over to Solly, who's going to talk you through the numbers, the technical intricacies, and how you actually transition through.
Right. What I'm going to do is take you through an example of how this can work. That's using the lowest risk, lowest cost options to minimise initial capital required. In other words, how do you, as an MGA, set about growing your own insurer? There's a number of things you need. Now this example, as Paul mentioned, uses a reinsurance cell in a protected cell company. This is the most quickest and most capital efficient route to market for a start-up. But unfortunately, it's not quite as simple as just paying over some cash and writing some insurance. There's a few things that are required. First one is the obvious one, a profitable book of business. This is a book of business that's currently making money for somebody else, probably your capacity provider, or you might have a good idea for a new business line. In the example that follows in the next few slides, I've assumed a book of business with 5 million gross written premium, increasing by 5% annually, with a loss ratio no higher than 50%, and I've allowed for total commissions of 20%. Now, as a reinsurer, there are no restrictions on the class of business that can be written in your cell. So you can write anything from liability to motor to household, anything that you're currently looking at. Different things having different capital requirements. So the example, I've used a general liability account. Now, under the Guernsey rules, this encompasses things such as professional risks, so professional indemnity, public liability, products, any kind of general liability cover. These numbers are the actual numbers that would happen if you were to do this for real. And you happen to have a book with £5 million and a 50% or better loss ratio. The next thing you need is good data. This is something to back up your belief that there is money to be made from this structure. There's no point going into this if you're going to lose money. It has to make money, otherwise, nothing works. Data is everything when it comes to business plans, and if you've got an existing book of business, you'll need to provide a good history of the account. Now, ideally, that means at least 5 years of policy and claims data. Now, they should be broken down by policy and by underwriting year. Where you've got a new line of business, you'll need lots of market research, some analysis, and detailed projections. Now, any insurance manager will be able to help with these, but the ultimate thing is it is your data and your idea. We're just providing the facility that allows you to turn that idea into reality. Now, the better the data, both in terms of volume and quality, the lower the uncertainty when it comes to the expected results. The lower the uncertainty, the lower the capital requirement, and the more likely you are to find the third ingredient. This is possibly your existing capacity provider. Because you're establishing this as a reinsurance cell, this being the quickest, easiest route to start, you'll need to find an insurer willing to share the risk with you. That's somebody who'll put up their paper and then share some of that risk with you in the background. It is possible to write business direct with a Guernsey insurer, but this can only be done on a non-admitted basis. This means that policyholders have no access to a local ombudsman. Qualifying policyholders will have access to the Channel Islands Financial Services Ombudsman, but there is no Financial Services Compensation Scheme equivalent, so your policyholders are out on their own if you fail. The insurer is also going to be unrated, which in these circumstances, especially for you as an MGA, is likely to be a deal breaker. So on this one, I've assumed a fronting insurer is used. Now, this fronting insurer is going to be quite cooperative, and in the example, will share 20% of the risk with you to start with. This is all about building a partnership with your capacity provider, changing the relationship from being a business producer to being a risk-sharing partner. So you share in the good times, you share in the bad times. The rationale being, you as an MGA will generally outperform the insurer's standard book of business, so your share of the profits will be greater. So, this fronting insurer could be your existing capacity provider. If your existing capacity isn't willing to share, it's possible to find a new partner, but depending on the class of business written, this might not be as easy as it sounds. Now, an insurance manager, any insurance manager, not just us, can provide introductions, but generally none of us control any capacity. So there's a lot of trawling around the market, a lot of meetings, sort of meeting people, explaining things, and trying to find somebody who'll see things the same way that you do. Now, that fronting insurer may want to retain some risk, or it may want to act only as a front. There are companies out there whose business model is purely providing paper. They don't want to retain underwriting risk. They want to pass that all on to a structure behind. These are the sorts of people that will generally be interested in what you're trying to sell. Anyway, regardless of whether the risk is retained or not, it's often prudent to minimise the risk in your cell, certainly in the first few years, by having some reinsurance, or retrocession, for those like me that are really anal about the correct term. This sacrifices potential profit in your startup phase, but it protects your cell, and more importantly, protects your fronting insurer from what we call the captive effect. Now, this is something that happens with a lot of businesses who set up their own insurance companies. You can take a book of business that's performed perfectly for 10 years. In that first year that you start retaining some of that risk, that's the bad year that happens. So in its simplest form, your reinsurance could be a quota share reinsurance. So you'll say retain 10% of the risk, your quota share partner will take 90% of the risk. That cushions you from the worst effects of any adverse development in the startup phase. The example that follows, This reinsurance does start at 90% and stays there for the first 5 years. This is a very cautious approach to building things slowly and allowing you to safely build capacity. From year 5 to year 10, it decreases down to 50%. This reflects the increasing financial strength of the cell and the reducing reliance on its external support. Now, the good thing about reinsurers is, generally, they'll pay you a ceding commission on the premium you pay them, so you generate an additional fee-based income in your cell. And finally, some skin in the game. Insurance is all about risk, and you need to be prepared to risk some of your hard-earned cash. Now, all insurers have mandatory solvency requirements based on the risks they take. In the UK and the rest of the EU, this regime is Solvency II. This is geared towards large commercial insurers. The sums involved are quite high. Guernsey is outside the EU and is not subject to Solvency II. Guernsey's own solvency regime was developed by the regulator and the local industry, working together over 3 years to come up with a solution that met international standards but still allowed Guernsey's specialist niche insurance industry to continue to operate. In practical terms, this means that the capital requirements are very closely linked to the actual risk in your insurer. It depends on whether your cell is operating as a pure captive, just insuring the risks of a non-insurance parent, or, as would be the case for an MGA, operating commercially, and whether it's writing insurance business direct or as a reinsurer. The capital also depends on the class of business being underwritten, with more volatile classes carrying higher capital requirements. Theoretically, for a cell, the minimum capital requirement is 0. In practice, this only applies to fully collateralised structures, such as insurance-linked securities. That's something for another lecture lunch, or a cure for insomnia. For a low-risk structure, such as yourselves, the requirement can be as low as £10,000, but a more realistic figure for a start-up insurance cell is in the £50,000 to £100,000 range. This compares to the £3 million to £5 million range to establish an onshore Solvency II insurer. So, based on the numbers that you're about to see in the next few slides, you'll need to find £60,000 cash, used notes, non-sequential numbers, brown plastic bag, for those that believe what the Daily Mail has to say about the offshore financial services. In reality, we insist on a transfer from a recognised bank in an approved jurisdiction. So what do you get for all that? You have a structure that starts with your customers and your brokers, who probably look like that, brings in your existing capacity provider, adds in an insurance cell that's your very own insurer, and introduces a new capacity provider in the form of a reinsurer. You will own 100% of a specific class of cell shares in a cellular company. Your cell will be directly authorised by the Guernsey Financial Services Commission, but it will not be publicly visible on any register. The company, as a whole, maintains the insurance licence, and any transactions your cell makes are made by the company acting on behalf of your cell. Your share ownership is confidential and not publicly disclosable, but the information is available to regulators and law enforcement agencies on request. Now, this does not remove any requirements under any FCA rules you may have when it comes to disclosing ownership of an insurer by an intermediary. It's typical with FCA things, the rules are not entirely clear on whether this includes a reinsurer, but we found when it comes to regulators, it's better to seek permission than forgiveness. So, that's the background, that's the bits you need to assemble. What are the next steps? How does this work in practice? And how long does it take? Data collection and analysis and the search for capacity providers is usually the longest part, and this can take months. There are so many factors involved in this that I can't even begin to estimate it. What we can talk about, and once it's all assembled, is the application for the authorisation to the regulator. This will need to be submitted to the Guernsey Financial Services Commission. It will be prepared by the insurance manager and will include financial projections based on your data. The GFSC will check that the financial projections make sense, that the cell will have sufficient capital to fund its activities, and that everyone involved in the cell is fit and proper. This latter part will involve you registering online with the GFSC, submitting your personal details, professional qualifications, employment history, and disclosing any run-ins you may have had with other regulators. This last point is very important as regulators do talk to each other and have access to information not publicly available. In many cases, disclosure and explanation will allow an application to progress that would otherwise be rejected if disclosure hadn't been made. Now, at this point, the solvency capital can be paid across to the insurance manager, who will hold it in a client account and will pay the application fee to the regulator. The big warning here, that application fee is not refundable if the application fails. So again, once you've got to this stage, the timeline from submission of the application to the regulator to writing your first risk is around 10 weeks. 6 to 8 weeks of this is the actual approval process from the regulator. The remainder is the inordinate amount of time it actually takes to open a bank account and get all necessary reinsurance and management agreements completed and signed. That last part takes about 2 days. It is anything up to 2 weeks for bank accounts. Once the bank account is opened and the regulator can see that the capital is in place, they will issue approval for the sale to transact. This is a same-day or next-day process. Once your sell has been approved, you can start transacting business. You'll be expected to provide premium and claims data to your sell and to carry out certain policy admin functions, and your sell will pay you a fee to carry out this work. Other than that, it's business as usual. But as I mentioned earlier, you may need to amend any of your initial disclosures to show your ownership of the sell. But finally, what does that actually mean in terms of numbers? What does your £60,000 turn into? What can you generate with your hard work? What does this cautious approach give you? So, who wants to be a millionaire? It can't happen overnight, but on these figures, if the book of business continues to perform well, it can happen. Now, I can, and as Paul will tell you, I frequently do, bore you with the detailed numbers, but that doesn't make for an interesting presentation, so I'll keep it as simple as I can. In the first year of operation, you'll have taken in £800,000 of premium. That's the 20% of your £5 million book after commissions. You'll have paid out £684,000 of reinsurance premium, again, net of commission. Claims in the first year are likely to be low, in this instance, £9,000 net of reinsurance. And after first year expenses of £63,830, that includes £25,000 of policy administration fees paid back to you for administering the policies you produce to this sell. You'll finish the year with £103,170 in the bank, not the number that's there. Because of the way insurance companies are obliged to account for future claims, at the end of the first year, you'll actually have made a loss of £19,455. Yeah, maybe your £60,000 investment isn't looking so bright at this stage, but in that same period, you'll have received £25,000 back in income. So year one, you've earned £25,000, your £60,000 is reduced to 40-odd thousand. You're pretty much where you started. Over the next 5 years, this is your building, your growth, your station, your phase where you actually build it up to something meaningful. So by the time you get to the end of year 5, at the end of your very cautious growth period, you'll have received £138,000 in fees, and your initial £60,000 will be worth £113,000. Your insurer will have just over £240,000 of cash in the bank, and you can start using this to retain risk, and this is where it gets more interesting. By the time you've got to year 10, you'll have received just short of £315,000 of fees, and your initial £60,000 will be worth a little bit more than £1 million. So, we've told you a bit about the two most commonly used insurance structures. We've explained how they can evolve and grow as an insurer develops, and hopefully I've demonstrated in practical terms how these structures can be used by an MGA to retain profits. Now, I'd just like to finish with the usual health warning on any set of financial projections. When I was a much younger insurance guy, my then boss, one David Margaret, commented on a very detailed set of year-on-year projections I'd painstakingly prepared. I can't do an impression of his voice. Well, of course, the only thing we can definitely say about these is that they're wrong. I'll repeat that same warning here, but I'll also repeat my response to him, which was, of course, you're correct, but the degree of inaccuracy is low over the long term. And this is the critical message here. It is up to you to generate business. If you are successful MGAs writing successful books of business, you can also run a successful insurer. Time for questions.
Yes, ladies and gentlemen, if you just stick your hand up, please. Teresa's got a microphone, and if you can, as I say, give your name, rank and serial number. That
She's going to enjoy getting up to the top gallery.
Yeah,
I don't know if you just want to shout.
Francis, shout away, Francis.
As we all know, it's very easy in life getting into things. Sometimes very difficult getting out of things. So, looking at the end of the sales line, how do you monetize it? How do you extract value from it? If things don't go well, you do it with the runoff and the claims and face your
Do you want to start with the run-off and claims part?
Okay, if a cell gets to the point of becoming insolvent, there are a number of steps that happen before then. I touched briefly on the solvency requirements. They're monitored on an ongoing basis by your insurance manager, and there's a sliding scale of intervention by the regulator. So we look at the ratios, and if they're deteriorating, we actually are obliged to notify the regulator. So there are lots of early warning signs if things are not going well. So you'll get a fairly good indication of if things are going badly for your cell. You'll have the option then to put in more capital, reinvest, or, in some cases, just to walk away. If you do walk away from it, you are only the cell owner. So you're not a director of the company, and it is down to the insurance manager, effectively, to sort out the mess that you leave behind. So again, the risk to you on that side is very low. However, the downside of that is that you will then be forever marked by the regulator in Guernsey as the former owner of a failed insurance entity, and this has implications on your ability to function in the insurance industry worldwide. So that's the run-off and the risk aspect of that.
The more interesting one for me is if you make a success of it, how do you extricate yourself and monetize that? There are a number of firms on Guernsey that are acting as consolidators, so they will buy books of businesses as well as cells and individual companies. So you could sell out to one of those firms. You could also sell the shares, be it in a cell or a standalone insurance company, to somebody else in this room and allow them to take up the mantle and run with it rather than setting up their own. So it obviously has value in it. And the ultimate one for me is actually you step back from the book and you take the income as an annuity in your retirement. And that's where we're seeing a lot of the planning actually going into. So rather than winding it up and monetising in one cash sum, people prefer to let the insurance company run and run and run and just take the income and the profit. So there's a multitude of ways around it. And one which hasn't been mentioned by either Solly or myself is you could actually put it into run-off yourself and manage it in run-off and slowly wind it down. Depending on the book of business you're running, that could be as short as 18 months. However, if you're writing longer-term insurance-backed guarantees, which run 25 years, you're obviously looking at a 25, 30-year period in run-off.
Guernsey or Malta, I know the presentation is around Guernsey. A lot of these structures are prevalent in Malta. What are the key differences?
The key difference is the time to set up and the capital you're required to put up. So the capital requirements with Malta being an EU jurisdiction are significantly higher, and the set-up time is an awful lot longer. Now, the protected cell facility does exist in Malta. They copied the Guernsey legislation, largely because people from Guernsey went out to Malta and set up the insurance industry out there, or helped to set it up. So there is an option to utilise protected cells in Maltese companies. The admin costs are significantly higher in Malta. The costs of doing business are higher, but you do have access to the EU. It's a timing, cost and utility equation to work out whether Guernsey or Malta is your best option.
And solvency requirements, are they materially different between the two?
Malta is an EU jurisdiction, so it is a Solvency II equivalent jurisdiction. So it's a minimum €3 million. Malta have some various add-ons they've added onto that. So you're looking at finding for a standalone anything up to about €5 million of capital. If you're looking to set up or utilise a cell in an existing Malta protected cell company, somebody like Atlas PCC, Atlas was a Maltese insurer that converted itself into a PCC some years ago. They're very good. They'll require you to fully collateralise your risk, or they will offer you the option of reinsuring part of that and renting part of their core capital. So the capital requirements for a cell could be equivalent in Malta, but you run the risk of your admin costs will be higher, And if you want to retain the profit and you want to withdraw from that structure, it's much more difficult to do because of the nature of the facilities that are offered over there.
Just from my perspective, the key differential, besides what Solly's touched on, is how you extricate and how you then sell on that structure to somebody else. The Maltese or Gibraltar regulations or other offshore jurisdictions are not as flexible as the non-EU ones. There are so many more hoops you have to jump through to find a new buyer or to push two cells together or to extricate it from a protected cell company into a standalone. So Guernsey gives you far more flexibility over Malta. But you don't have the EU passporting rights, which may be critical for your operation.
If I can then just ask a few questions of my own, just from my
I was expecting some from you.
inquisitive nature. 10 weeks to set up a cell. How long does it take to transfer into a standalone company, and how long does it take for a standalone company then to sort of migrate to one of the EU states other than the UK?
From personal experience.
Personal experience. The cell extraction, there's only been 2 on Guernsey, from a cell to a standalone. We are one of those 2. That took us between 3 and 4 months to actually achieve it. Reality is, because we are the first ones to have gone through it, the regulator didn't understand it. Our equivalent of Companies House didn't understand what we were doing. And we actually ended up for a 48-hour period with an insurer without a licence. And the regulator admitted it was their fault in the end, which was quite nice. I did like that phone call. So in theory, a cell extraction should take 4 to 8 weeks. And now that we've got the process agreed with the regulator, 4 to 8 weeks should be the standard. On top of that 4 to 8 weeks, you have a 3-week notification period with our Companies House. So if we average it to 10 weeks, you should be okay. Redomiciling a company from one jurisdiction to another, that is far more problematic. It depends on the type of business you are transacting. It depends on the jurisdictions you select. As an example, I redomiciled a company from Guernsey to the Isle of Man. It was an international life insurer. And the Isle of Man authorities insisted that we publicise in the Gazette of every jurisdiction we had policyholders. Significant time, significant cost. In the end, we binned off the idea and it remained a Guernsey insurer. So I can't tell you how long it will take. A Maltese company coming to Guernsey, which was a Maltese insurer to Guernsey, I believe took 6 months, and that was a general insurer. So it is how long's a piece of string and where your business is and how amenable you are to spending the money.
I may say that in comparison to going to the PRA just to get a variation of permissions, which took 9 months in my experience, that's quite quick. Anyway, I suppose my other question is so I have my standalone company, I migrate it. What is going to be the effect of Brexit on that potential to migrate? I've got to ask the question. I may say our own regulator would just simply say, we don't know, we haven't been told by the Treasury yet, but, you know, what's your guess?
I can answer that one quite simply. The UK doesn't have migration legislation, so you can't move it to the UK.
So what about migrating post-Brexit from Guernsey to France?
It will be unaffected by Brexit because Guernsey's outside of the EU, so you'll still be able to migrate. However, and this is the uncertainty, it is unclear whether you will then be allowed passporting right into the UK or even passporting permission right into the UK.
That's a wider discussion.
And that's where you'll find your potential issues will come from. Moving it to other countries within the EU, the legislation's there, that won't change.
Good. Right. Are there any other questions from the floor, please? I see no more hands. So my thanks to Paul and Solly. And if we could thank them in the usual way, that'd be great. Thank you very much.
Rightly have pointed out that we've got the IDD paper 2. This morning, paper 3 came out, which I think is quite interesting considering they don't know what they're doing and they're now telling us how to do it. But that's coming round, sorry, I'll probably send that round on Friday, so we can have a look at that. But we do need your responses both to SNCR and also the IDD, because it's our chance to have that voice. Thank you, Chair.
No problem.
Thank you very much.
No, no problem. It's a good topic. It's a topical topic.
It is.
Of course, my own chairman, of course, is the chairman of the GFSC. You know,
Yes.
Mr. Schmauer.
Yes.
You know.
Amazing how we cross over, isn't it?
Yeah.
Speak like I was chatting to one of your members, and he's got a structure in Guernsey already.
It doesn't surprise me. I mean, you know, there's been so many sticky points about. You're right. How are you? Stand out the light. Brian Russell, one of the family members, he went to Bourne from. So, you know, these things are sort of happening and happening and happening.
That's okay. Thank you.
Thank you. New to me a little bit.
Well, this is but this is not. This is going to be one of the ways our ILS legislation will not be flexible.
Yes.
Well, the interesting thing is we've actually got a non-solvency II firm going through PRA application at the moment to a non-director firm.
It's something we'll work on. There are, historically, Lloyds has never ceded its business to captive. Some syndicates do. I can say with certainty,
and actually the solvency
with their syndicate, have fronted captive business for a large firm that operates black capital.
I think that'll be, I think that'll be the fun part.
I'm not au fait with all the Lloyds bylaws and what can and can't be done. Yes,
it's gone.
But historically, Lloyds syndicates were not permitted to reinsure.
Yeah, they collected it, they ran up, grabbed it and ran.
As far as I'm aware, that restriction is gone. So it can be a simple reinsurance. So it's something we're trying to work on is finding Lloyd's capacity because Lloyd's is it's universally welcomed. It's got access to so many more markets.
Sorry. Email.
Okay, email.
Cheers.
Yeah.
Yeah. It has to remain Lloyd's paper.
Yeah.
But post-Brexit, that might change because it would be Lloyd's bosses.
I mean, certainly you could stick with your existing paper and the syndicate could reinsure to your own captive. And that's the... It never used to be that, but as far as I'm aware, it now is. So it's a case. It's having a conversation and explaining.
It's up to the
contingent. Yes. Yeah. What we can do is, I didn't touch on because it's quite a dry presentation to start with, and I didn't want to make it any drier than it had to be. We can provide collateral solutions that get round the unrated issue. So certainly for Lloyds or for any Solvency II insurer.
Well, they could retro it back in, couldn't they?
They could, but you want to retain some risk to retain some profit or generate some fee income.
Yeah, if we're starting,
yeah.
then they can retro it.
Or what we can do is you can put the premium and the sell capital into what we call a trust account and use, this only works with Guernsey or Jersey companies, you can use a security interest agreement which creates a transferable security in movable intangible property. You can create a security interest over a bank account or investment portfolio and give that security to a fronting insurer, and that counts as regulatory capital on their books.
Okay, so one or two. The other thing we do quite a lot is foreign exchange and payments, international payments. Is that of any interest to you, that side of life? Foreign exchange payments? We do it for MGAs, for brokers and organisations.
I don't know. I mean, we...
AmBank, for example.
Yeah, we know AmBank there. Funny enough, funny enough, well, Richard T, who works for Heritage I used to know, I was on the same plane as him on the way over this morning. We wandered over to London Bridge this morning. Yes. Yeah, we do have one of our clients is an international insurer, so we make payments in Indonesian rupee, in Malaysian ringgit and all sorts. Yeah, we might be at the moment we are being hammered in bank charges. Yeah. Yeah.
What they do
Yeah.
they've got the whole market because they trade 20 billion.
Yeah.
Yeah.
That's where one of the systems
And we've introduced them to, we picked up this class.
Yeah. Yes.
Because I know Colin quite well. We picked up
Funny enough, that's what we were on the mother as well.
Yeah.
So you might find out,
Yes. Yes, that's certainly something.
but let me keep that because stuff will happen. And we'll see what happens. I enjoyed your presentation.
Thank you.